Welcome to the fifth Finhaven Investment Forum. Our topic of the day is how to invest your money in this rising yield environment. I'm glad to have our distinguished panelists to contribute to the discussion, Tina Mu, Peter Yang, and Lavelle Lindo. Finhaven is a financial technology company. Finhaven's subsidiary is Finhaven Capital, running its private markets. The markets provide vetted private deals and alternative investment opportunities in a fully digital way to investors. Please visit finhaven.capital for further information. Without further ado, here's my first question to each panelist. How do you see the current economic climate? What are its implications on the real estate markets in Canada? First to Tina Mu. Tina is a co-founder of Gentai Capital Corporation. For the last 10 years, she has successfully delivered high returns to her investors with her mortgage investment corporation. Prior to Gentai, she was a senior business advisor at one of Canada's major financial institutions. Tina? You're on mute, Tina.
First of all, I'd like to take the opportunity to thank, DH and also Finhaven to have myself and Peter here. And thank you for the opportunity. And comes down to the first question I have. To me, because of the high inflation rate caused by the limited supply chains during COVID-19 and the war between Russia and Ukraine, Bank of Canada hiked interest rates 7 times in 2022 and expect another hike on January the 25th, which is next Wednesday. So after so many years of a low interest rate environment, we're at the highest interest rate since the 2008 and 2009 financial crisis. And the high interest rate increases the household income paid towards interest payments of debts, and plus the possible US recession will push down Canadian economic growth for the next 3 quarters. So we believe the Bank of Canada's rate hiking cycle has come to an end, and the full effects of the rate hiking are yet to be reflected, and the economic recovery will show at the second half of 2023. To myself, I believe the real estate in major centers in Canada is near the bottom, and the market recovery may be on the way. And Canada is more premium than the rest of the world in terms of the stable political environment and a well-developed economic system and a conservative financial system and a positive immigration policy. So all of those factors and attract the immigrants from the worldwide. And those people come to Canada with a strong wealth. And the real estate in Canada is supported by the factors above, and the demand will continue to will actually stay strong. As a lender of Gentai Capital, we are cautiously optimistic for 2023, and the risk management is the first priority instead of a growth, and the survival would be the key for the current market.
Right. Thank you, Tina. Just as a follow-up question, do you think we have sort of bottomed out in real estate markets in generally in Greater Vancouver or Greater Toronto areas?
I would say we're towards to the bottom, but we're not at the bottom yet.
Okay, thank you. Now, next, the same question goes to Lavelle. So, Lavelle, Lavelle has spent over 20 years in building and growing strategic relationships with the financial service within the financial service industry, and he has real-time financial market intelligence coming from his deep and wide relationships in the wealth management world. So, Lavelle, what is your take in terms of the current economic climate and its implications on the real estate markets in Canada?
Thank you, DH, and thanks everyone for joining. Just an awesome opportunity to talk about things that we actually get passionate about here at Equiton. And the reason why is I'm gonna ask you all a quick question, and it comes in the form of it's almost like a quiz. So let me know if you can see the screen right now.
Yes.
Perfect. Okay, so the question that kind of outlines our view on the market is this. What are the 5 most expensive cities in North America? And, feel free to put something in the chat or whatnot, but, actually, you know what? I'll give you 10 seconds. Just type in what anyone may think is one of the 5 most expensive cities in North America. So it's coming through here. All right, so Vancouver, absolutely. That's usually something that everybody would say. Any others? New York, perfect. We need 3 more. San Francisco, exactly. 2 more. Guys, don't let DH take all of the glory on.
Sorry.
No, please keep going though. You're right. You're right.
All right. Okay.
All right. So we have we have Vancouver, New York, San Francisco, LA, Toronto, and all you have to do is just wave your hand if you think that DH is right with those 5. Perfect. We see some hands going up. Excellent. So here it is. Toronto, you are correct. It's actually number 5 on that list. Number 4, Hamilton, Ontario. Number 3, absolutely, Vancouver. You all know it. Very expensive city to live in. Number 2, crashed the computer. I don't know if you see it, but my screen went blank.
It's blank.
Well, there it is. Mississauga, Ontario is number 2. New York is number 1. So keeping that in mind, we have 4 out of the 5 most expensive cities in North America are in Canada. And further to that, 3 of those top 4 are actually in the province of Ontario. And so that lets us know, and by expensive, I'll qualify that. They're talking about wages compared to cost of living, food prices, transportation costs, housing costs. So it groups everything all into one. But you're looking at Canada as having 4 of the 5 most expensive cities in all of North America. Yeah, LA, San Fran, Boston, Miami, Chicago, you name it. Any big city in the US, Canada has 4 more expensive cities than them. And so that kind of really gives us an opportunity to look and see, here's the other thing. Canada is in a supply and demand crisis for housing. CMHC warns that Canada needs 5.8 million new homes by 2030 in order to tackle this affordability crisis that we have. And they've slated 2.3 million homes so far. They still have negative 3.5 million homes that they have to get to in order to just get to home affordability by 2030. Well, how do we do that? Because right now we have the highest levels of construction job vacancies and the lowest levels of construction jobs unemployment, meaning everyone who can work in construction is working overtime, and we still have the highest levels of job vacancies. And so, the government talked about in 2025, bringing in 500,000 immigrants into the country. And they said, they updated that to say, we're going to handpick, we're going to select those with skilled labor around the world. Why? Is because they need help with this affordability crisis. They need help in having to build out these homes. But, to the current market, what we're seeing, just as Tina rightly said, and everybody has experienced, interest rates have risen, right? They've risen, 7 times over the last year and another time coming. And so what is that doing? That's cooling down the housing market. The question that DH followed up was, do you think that we've seen a bottom in the housing market? Well, here's where we haven't seen a bottom: in the rental market, because as house prices, have come down, rental rates have actually gone up higher. They've never been hotter. Students are now struggling to secure housing in Canada's overheated rental market. Soaring rents price out some Canadians. right? So because obtaining a home and a mortgage is now harder to do, people who have been renting have said, oh, you know what, I can't buy a home right now. I have to re-up on my mortgage. I have to re-up on my rent. And so they're now renting. And what that's done is put added pressure into the rental market. And so when we talk about real estate, there's actually, we see it, there's two different markets in the residential real estate space. And this is my final point for this question. There's single family homes, and then there's multi-residential spaces. And what you see in this graph here is that 4 periods going back to 2008, where you saw a decrease in the price of single family homes. During that same time period, you saw an increase in the multi-residential apartment space in Canada. And last year, March 2022 to September of 2022, similar factors. We saw house prices dip 15.5%. At the same time, the Canadian multi-residential space was up 2.6%. And that's what Equiton invests in. We have a 100% Canadian multi-residential apartment portfolio, and we have seen great opportunities in this market because this is what happens during periods of high inflation, is rental rates go higher. And so what our outlook is, we think that there's great opportunity for us going forward. Sorry, Brett, I think you're muted.
Thank you, Lavelle. And many times we make wrong investment decisions in listening to news. And Lavelle, we tend to hear a lot of U.S. news and general real estate markets. Are you seeing we are in different environments in greater Toronto area, greater Vancouver area? We really have to process the news that we hear in terms of making our investment decisions in the real estate markets in these two regions of Canada.
You're absolutely correct. We do. We absolutely do. I mean, the demographics between Canada and the US are very, very different. We look at Canada and we say, here's our factors, right? Here's population growth in Canada. And as you can see, they said in 2025, there's going to be 500,000 people coming into the country. They also said that's going to go on for 3 years. So between 2023 and 2027, there's going to be 2.5 million new immigrants coming into this country. And that's not including the 100,000 Ukrainian refugees who they've also decided to let in. So that's the high watermark for population growth in Canadian history, right? And so what we're seeing is you take a look at this slide, and this is the cities that we own buildings in. And again, Equiton has focused their building portfolio to be in Ontario for this reason. Its population growth in all of these cities over the last 5 years has been very, very great. In the US, you don't get those kinds of numbers because it's a society that kind of switches jobs, and people will move across the country just for a job. Not so in Canada. It's pretty stagnant. And so two very, very different markets. And so we have to be very careful when we're listening to the news to ensure that it's actually focused in the regions that we're in.
Great. Thank you very much, Lavelle. Now, then, what would be a kind of good strategies to win in investments in real estate sector in the current market conditions? And I'm going to ask this question to Peter first. So Peter is a co-founder of Gentai Capital Corporation, along with Tina. Peter, for the last 10 years, delivered superior risk managed returns to their investors. He has wide experience in financial services, real estate, and mortgage lending over his 25-year career. Now, Peter, so what would be the really the winning strategies in real estate sector in under these current market conditions?
Thank you, DHL, and thank you, everybody. It's my pleasure to have this communication with everybody, and I share our passions and our thoughts on the market and what Gentai can bring to the table to our partners, and also our investors. First of all, in my opinion, the traditional asset allocation 60-40 is not adequate. And in my opinion, real estate or related alternative investment should be one of the pillars of personal wealth creation and growth. And in particular, the mortgage fund, because it's underlying collateral and also down payment, it's a good vehicle to give us super return with the adequate risks. For example, when you choose the vehicle, to grow your wealth, real estate and also alternative investment should be part of your portfolio. That's the first things we should look at it. Then in current situation, how you choose a sector or fund. You can look at the histories of the fund and also the underlying risk factors. Like I mentioned in our, we call GMIC portfolio, our current LTV is like 62%, which means if the current real estate market decrease 38%, at that time, our capital might affect it. So in this downturn or uncertainty, the risk control and also the risk aviation is the most important one. The mortgage fund would give us that kind of a safeguard in the first place.
So you just mentioned the GMIC. GMIC is Genesis Mortgage Investment Corporation, is it?
Yes, yes.
Now, just for the people who may not be familiar with the Mortgage Investment Corporation in Canada, Tina or Peter, one of you probably can explain what is a Mortgage Investment Corporation, and at the same time, is it safe to invest in MICs?
Yeah, so for the mortgage investment entity, we call that, including Mortgage Investment Corporation, it's basically a fund. So we got the money from the investor, or no matter institutional or individual investor, we lend it out as mortgages. So each mortgage will have the collateral and also the what we call PPS for the borrower. So because of the underlying real hard asset, it gives us a margin of safety, especially in downturn environment.
Okay, thank you very much. And I think LTV 62% is pretty good. What is the let's say the first tier financial institutions, what is their current LTV?
It depending roughly maybe a little bit less. The big four a little bit less in around 60, I think.
Okay, thank you. Now the same question goes to Lavelle. So what is the leading strategies here?
Yeah, thank you. I think what Peter said was very true and very interesting. And when we talked about the 60-40 portfolio, that traditional way of investing quite simply doesn't work in today's market. I think looking at this, we're seeing that alternatives are now taking up a healthy portion of most investors' portfolio, up to 25%, many more, up to 40-50, and Preqin actually is a leading data provider to the alternative asset community, and they see investments in alternatives rising to more than $17 trillion by 2025. That's roughly a 60% growth rate from 2020. Now, what's actually, what's given rise to that? Well, you look at last year and you'll see that the S&P 500 tumbled 20% during the first 6 months of 2022. That's the worst first half decline on that market in half a century. And then the bond market experienced its worst decline on record. And then the typical 60-40 portfolio, at least in the US, produced the worst return since the Great Depression. And so investors are now saying, I mean, there's got to be somewhere else we can go. And where is that? Well, private real estate certainly is a great bet for that, for many reasons. Protection against the market, emotional market, right? What took the market down in the beginning of February or in the middle of February? Does anyone know, right? Nothing fundamental to the actual stocks or the underlying companies. It was the war in Ukraine, and that fear and that emotional volatility took the market down, and this is where we are today. So private real estate gives you less volatility, low correlation, improved returns with less downside risk. You get consistency in your returns. It's a natural hedge against inflation. And, here it goes. What index has never had a negative year in the last 35 years, including the last 5 financial crises? It's the private Canadian apartment index. And here you see, going back to, the tech bubble of 2002, the global financial crisis in 08, COVID-19, the geopolitical event, the Ukraine, just this past year and still going on. The Canadian Private Apartment Index has never had a negative year through any of that. And so when we talk about lowest volatility and highest risk-adjusted returns, out of US equities, emerging markets, Canadian bonds, Canadian equities, global equities, everything that's in a typical client portfolio or anything that's in our investment portfolios for the most part, you're going to see that the private Canadian apartment index has lower volatility and higher risk-adjusted returns out of all those categories. So by adding it in, you're immediately getting diversification benefits from that. So again, historical low or negative correlation to pretty much all other asset classes is the Canadian Private Apartment Index, right? And then when it comes to greater market downside protection, right, which is the big thing that every investor wants, it's not a matter of how much you go up, it's how much you don't go down, how much you don't lose. And when we're calculating this, we use a ratio called Sharpe ratio. It's very complicated to have to calculate, but all you need to know about Sharpe ratio is the higher the better. And if you can see on this, the private Canadian apartment index has a Sharpe ratio of 1.35. Nothing else on this graph even comes close to 1. Emerging markets, global equities, Canadian equities, US equities, Canadian bonds, commercial real estate, office, industrial, retail, nothing comes close to 1. And so, you're in your best bet when you are with the private Canadian apartment index. And just finally, a graph I really like is this one that kind of talks about consistency for over 30 years. Now you look to the far right, you see emerging market equities and that 82% return. I mean, tell me an investor in the world that does not want an 82% return. All of them do, but no investor wants a negative 41% return in 1 year, because in order to even make that back up, you have to do double, right? And you look to the far left and you see the private Canadian apartment index. Well, look, a high of 22 in a year, I mean, it's good. It's not 82, but if your worst year is 1 point plus positive 1.7%, then, over a 33-year period, you're at a 10.3% average annual return with no volatility, as opposed to the emerging market side, where after all that volatility, you came in at 13%, 13.45%. That's too much volatility for, most investors and what their parameters are. So, I mean, if we're looking at good solutions and good ideas and good stories, we're saying the private Canadian apartment index has held in the past, in the worst of times. And so we expect and see that to continue, because the factors that affect Canadian multi-residential apartments are population growth, housing affordability, and land scarcity. And we don't see any of those issues abating anytime soon.
So Lavelle, 22% return, let's say annualized, that's an impressive number. But we're talking about inflation and hedge against inflation. Two follow-up questions for you. So do you see that return will go up along with the yield, the recent yield? So let's say essentially the cap rate in the real estate market will catch up with the rising yields. And second question for you is, do you have a kind of data for the great inflation period, from 1965 to 1982? Was, real estate market investments, was it really hedged against the inflation even back in those days?
Yeah, really good questions. When we're looking at it, this is the annual performance. This is the US data first. My Canadian slide is next. But in the US, there was more periods of inflation calculated as greater than 4% or greater. And you can see going back to 1978, 79, 80, 81, 87, 88, 89, 90, 2007, 2021, anytime there was a period of inflation over 4%, the US private apartment index beat the average rate of inflation, except in 1990, it tied it at 6%. But if we're looking at Canada's numbers, and we're going back here to 85. This is when the private Canadian apartment index started. We got numbers for it starting to show. You see again 85, 86, 87, 89, 1990, the periods where inflation in Canada was high. The Canadian private apartment index beat the annual rate of inflation there as well. And why? You're right. Like, why is that possible? Well, there's a couple of different things. Property values usually keep pace or exceed inflation because it's inflationary, so values go up. Rental rates actually lift during periods of inflationary expansion. And the reason why and rationale, we'll go back to that first slide that we talked about, with the headline news where interest rates are rising, but rents are getting hotter, right? House prices are coming down. That's putting more pressure on the rental units because people are saying, I got to sell my house. Well, if you sell your house in this country, where do you live? It's too cold to live under a tree, right? So you have to go somewhere and live, and most likely you're renting. And so that's what's happened. People who can't afford housing, they have to rent. Well, we still have immigrants coming into the country. We brought in nearly 800,000 immigrants last year in 2022. And look, that was a pickup from the pandemic years. But again, remember, we need 5.8 million homes already just to reach affordability. So where are these people living? They're not coming in and just buying $1 million homes all over Canada. People are coming in and they're having to rent, get themselves settled until, they can make things happen. But, demand slows during inflationary periods, right? And accelerating demand for existing properties. Now, we've seen that. We used to have to change. There was a time where you would change your rental rates, your market rates for rents. You would change them annually and then quarterly. And we saw quarterly changes in rates. And then over the last couple of years, it moved to monthly. I found out last week that we now change our market rents bi-weekly. Every 2 weeks, we have to up our rental rate in order to keep pace with the market, with where rents are going. So I remember in June of 2022, the national average for rents was $1,800. I remember looking at the numbers in September to update my deck, and the numbers were $2,000 a month for rent average. And then you look further on into November, and it went up to $2,100 a month. $2,100 a month is the national average for rent. And so what we see is that because of inflation, rent prices lift, and what it does is it actually outpaces cap rate expansion. So we see, yes, there is cap rate expansion happening. Now, it's more drastic if you're in different areas of the country. Being in Ontario, where there's just a lot of activity and desire for rents, there's a lot of interest in market. We're seeing that our buildings are holding a lot of value because we're getting bidding wars, in our rental units. And so it really depends on where you are, but we have absolutely outpaced the cap rate. So what's happened is our buildings haven't gone up in value as fast as they would have if cap rates were a bit lower, but we're still definitely outpacing cap rates.
Thank you, Lavelle. Thank you for a great insight and very detailed data. Now I'll go back to your own, winning strategies in your investments. But before I go back to you, Peter. So how do you manage your business to win in these market conditions to provide a superior returns to your investors? And if you can touch kind of your risk management along with that, that would be great.
Okay, thank you, DH. Let's in the business of lending, just like any other business, successful business, the key would be the management, the directions. And in lending, it's not sign high-tech or sophisticated calculation. It's common sense. One, do you get enough deal in the marketplace? Do you have the capability to assess the risks? Do you have the platform to monitor and execute your strategy? In our Gentai, I think during the past 10 years, it's been proven we successfully reached our targeted return, which is 8% single return. And it's been proven during the lower interest rate. And also right now we are facing the interest hike, but the principle would be the same. You know your stuff, you know what you are doing, and you have a plan. The risk control would be the number one for us. We don't want to chase in the yields. The safety of the investor's money would be our number one priority. That's always been the case. We are not the highest return in the marketplace. That's not our goal. How we can get to the desired results? In the past, I mentioned the common sense approach. Do you have a plan? Do you have the system in place? How do you underwrite the risks? For our current portfolio, we can look at the one I emphasize. We got a term to maturity. It's only 8 months, which means because during the past 1 year, the valuation of the real estate in overall declined, depending on the asset type and also the region. And for us, in 8 months, we can readjust, deploy according to the current valuation and the current increased interest. So, and also in our current portfolio, majority of our interest term is variable, which means we got a floor. And also, if the interest rate still keep hiking, we can capture the extra yield during the hiking process. That's give us advantages to control the risk and also give us the room for higher return potentially. And one thing is very important, the management interest alignment with the investor. In Gentai, we think the investor's money would be our money. We are just a stewardship of the investor's money. So up to now, including myself and Tina, and also the employees and some family and the friends, totally we invest 11 million into our total portfolio. it's assign our interest monetarily in alignment with the borrower. We have confidence in our fund. That's looking at the strategy. I just briefly will give us a reflection on the state, especially on commercial market in Canada in year 2022, and what's the outlook and what's the opportunity for us. During the past 1 year, we see several things. One, we got lower loan closings. It's obviously because the activity in real estate transactions decrease, and we have a lower loan closing. And also, the second would be mortgage rate increase. It's obviously Bank of Canada start the hiking cycles. That's why the mortgage rate increased both in residential and commercial. And also during the past 1 year, the shifting lender compensations. And also we see on the marketplace as a lender, more conservative underwriting. And one thing is very important. In the current stage, we are looking forward the peak rates. As a lender and a borrower, we navigated the volatile markets. Many questions will arise. How much longer central bank will continue to tighten interest rates and when they might stabilize? The past cycles offer some insight into the length and the magnitude of increases. The current cycle in Canada is a little bit unique due to the condition that led to the higher inflation, a period of stages of a pandemic, the economic recovery following the relaxation of pandemic-related restrictions, and the supply chain disruption that ensured, and also the global energy supply issue that emerged because of the Russian-Ukraine conflict. So the magnitude and the time might exceed the historical patterns. So for us, as a lender, there is opportunity. Right now, we're still with the signals that the tightening might be continued, although many, since we are at the last stage of this interest cycles, and we think there will likely be a period of a relatively conservative underwriting and lender selectivity in early 2023. Right now, borrower is in need of a refinancing. They are likely to face lower proceeds on newer senior loans. As an alternative lender, it gives us opportunity maybe to catch this market to cover the shortfalls in the new senior loan proceeds. Because for us, the mezzanine loan and the bridge loan would be our focus and our specialty market. And also, in general term, in the market, as a general aside from the office sector, the supply and the demand, the balance in commercial markets remain healthy, I should say, particularly in the residential multifamily and apartment sectors. And those market, I think if we choose the right borrower, it will give us the risk-controlled return in the marketplace, but it all depending on the management. Do you have enough deal flow? Do you have strict underwriting guidelines? Because our variable terms give us the extra room for a higher return. On the other side, because of a decreasing of a valuation, there's a chance, there's a risk factor. We should consider how to mitigate the risks and give us a higher return for the investor. So in a word, we are fully prepared. We have the capability to grow our business and give our investor above average return. That's our goal. Yeah. Thank you.
Thank you very much. Thank you very much, Peter. Tina, I have a very short question for you. Lavelle mentioned the new immigrants that we are expecting, large number of new immigrants we're expecting, in Canada. Is there any like your client base? Is it like, do you see a big demand in terms of mortgage and lending? Due to the inflow of immigrants to Greater Vancouver area or Greater Toronto area?
Definitely, because our background and we have quite a lot of immigrants from China and also from Eastern of Asia as well. And there's always have a switch, and especially with a lot of people that are international students. Apparently, this is the group of the immigrants Canadian policies are focusing on right now, and they are well established in Canada, and also they have the ability to make the purchase, to start the life in Canada. So both in BC and also Ontario, we see the huge demand. And, for the moment, that's why I said I believe there's a very strong supporting point in the real estate market because of this very positive immigration policies from the federal government.
Thank you very much. And Lavelle, so this is the last question. So how do you, what would be a kind of good strategist to win in investments in real estate sector? That was my prior question. Now, relating to that, how do you manage your business to win in these market conditions?
Yes, it's Equiton has got a great story. It's been around since 2015, launched the fund in 2016, and since that time has steadily grown. It started with 3 employees back in 2015. Today, we're over 134 employees. I remember I came in and there was 59 employees, and now we've more than doubled since I've been at the company at the beginning of last year. And in essence, the AUM was at 583 million when I joined. Today, we're approaching $1 billion, and we've just seen explosive growth. And that's due to our management style and the conservative nature of how they manage, but also how strategic they are and where they go in the country and in amongst the city. And so, there's a machine behind what we do now, and it's really given way to the strategy. And in essence, we look to purchase underperforming and undervalued multi-residential apartments, and then we look to put a value add strategy on them as well, a value creation strategy. And what that is when somebody moves out of the apartment building, we'll now renovate it and then put it at market rate. So before it was being rented out below market, and now it's at market rate. Well, we've got a gap to market across our entire portfolio at around 27%. And so that strategy is what continues to win. That's how we're able to beat inflation, further beat inflation, is that we're constantly upgrading our buildings and creating more value in them, and then putting our suites up at market rent. And so clients get monthly cash flow. You're getting 6 to 7.25%, just depending on the series that you're in, just as a distribution. And then there's also capital appreciation. The distributions are 100% return of capital, so all rock, and it's really the most tax efficient way of receiving a distribution. But further to that, our numbers have been good. We have 80 consecutive months of consecutive positive returns, and that's just due to the strategy of being able to buy buildings that are undervalued, seeing things that others don't see, and creating value, within the building. Just last year, our unit price was up 0.83 cents. So we're up to 11.88 now. The trailing returns, net trailing returns was 14%. That's net of all fees. And so in a market where stocks were down, because usually that's where you go to get your performance. And so stocks are down. Well, okay, well, let's get conservative. Let's go to bonds. Well, bonds were down. What do you do now? Oh, well, let's go to cash and just preserve cash. inflation was at 8%, it ate at your cash. So where do people go next? Well, we returned, 14%, trailing return net of all fees. And so, the investors who have invested with us over the last number of years, they sing our praises like none else. And again, we've got over 8,000 investors now, with Equiton, and more coming through the Finhaven platform, because I know you're very strategic with the companies that you've invited on, and we're one of the best kept secrets of a company in Canada that is in this space. And so we think that the opportunity is rich. Again, our assets under management have driven up the number of doors that we have. We're up to 2,500 doors. Again, 80 months of positive returns, good unit price growth, distribution growth. So our distribution is based on the number of units that you have in the price. So as our NAV ticks up, your distribution actually gets, your yield gets better. So again, as a company, we think that this should continue, because again, we're in Canada and we have 2.5 million people coming into the country, and they have to live somewhere. It's a product of necessity. And that's what our portfolio is, 100% multi-residential apartments in Canada, and in the areas where the population is growing and the demand is very strong. So yeah, we think that private apartments is the place to be, at least a portion of your portfolio. Absolutely, grab a MIC as well, right? Gentai Corp. You can't have everything in one strategy. So, use a MIC, get some yield there, but private apartments are going to give you a ton. Your valuation is representative of the actual building, the actual value of the business. It's not market sentiment, right? It's not somebody tweets something, the market goes up. Someone else tweets, it goes down. A war starts, the market goes. No, the value of the properties hold themselves in. So the pricing is rational, it's fair, and it increases with low volatility. You've got availability, if you just wanted to go out and buy a $55 million apartment building right now, there's a process, right? Or else if you had, 50,000, 100,000, and you just wanted to put it in and into an apartment building, well, you get ownership immediately, right? And then you also have liquidity, monthly liquidity. If you wanted to sell that building, you're going to have to wait until there's a buyer who's willing to pay $55 million for your building. And there's not a ton of them out there, right? But if you want to sell, monthly liquidity, on the platform, there's trading opportunities. And diversification, right? It's going to be different than everything else in any investor's portfolio. And I can say that knowing that the majority of investors out there do not have an allocation to a 100% weighting of Canadian multi-residential apartment real estate. And they should, because it's a great opportunity to secure some market consistency in your portfolio.
Thank you very much, Lavelle, and thank you, Tina and Peter. Thank you for participating at Finhaven's 5th Investment Forum. If you're interested in investing in Genesis Mortgage Investment Corporation or Equiton Residential Income Fund Trust, and if you're not a registered investor at this point at Finhaven Private Markets, please visit finhaven.ca and sign up as an investor. Thank you again for your great insights, panelists, and we'll find another time, at different market situations to provide another kind of winning strategy to investors. I think we just introduced a very good diversified investment opportunities for our investors today. Thank you again, and have a wonderful day.
Thank you. Thank you, DH.